All right. Hi, everyone. Welcome to Vortexa's global webinar. I'm Serena, and I lead up the analysis team here in APAC. And joining me today are a panel of Vortexa's finest analysts. So we have David, who is our chief economist, Ross, who is our senior fuel analyst, Emma, who is our China market analyst, Dylan, our freight analyst, Rohit, our senior oil market analyst, and last but not least, myself. So just some housekeeping rules before we start. So this session will be a 1-hour session where we will have a 45-minute presentation followed by a 15-minute Q&A. At the end of the session, you'll receive a copy of this recording as well as the presentation slide deck. If you have any questions for us during the webinar, feel free to pop it inside the Q&A box at the bottom of your Zoom screens. So to start and lay out the background for the oil markets, what's really happening is that the global oil market is really going through one of the most volatile periods, I would say, in history. And it's really very much characterized by a series of uncertainties in both the global supply as well as the demand side of things. Well, on the supply side, we see OPEC plus production cuts that are imminent, the EU ban on Russian oil imports, and rising geopolitical risks that is really casting significant downside risks to the supply side of things next year. But from a demand perspective, the rising global economic headwinds, the stubbornly high inflation, all these factors are really tipping the global economy into a recession. And what's really imminent right now is that the EU ban on Russian oil imports is taking place at a time when, Europe is heading into peak winter demand, whereby the seasonal demand for especially heating fuels is reaching one of the highest this year. And there are concerns that Europe may not even have sufficient heating fuel in December. And in the recent months, as a repercussion of the Russian-Ukraine invasion, we've also started to see a reshuffle of the global oil trade flows, and this is set to accelerate. We've seen a rise in tanker utilization that is supporting an increase in tanker rates. But what lies ahead for the tanker market? So in today's webinar, we will be discussing these questions and these market trends. So without further ado, let me hand over the time to David.
Yeah, as a first point, we're looking a little bit into the question how the European Union, how Europe and the UK are doing in replacing Russian crude. On the right-hand chart, you see European crude imports split into the dark blue bars of Russian crude and in the yellow bars of all other sources. And on the right-hand slide, you have the share. And especially the initial data for the first half of October is now showing to an extremely low share of Russian crude in Europe's crude diet, about 5%. Generally, that makes sense because the closer we get to this 5th December deadline of basically Europe implementing its crude import ban from Russia, the more European players will get rid of. But let's focus a little bit on who is actually coming in as alternative supply. So on the left-hand chart, we are looking at this first half October versus the January figures. And you can see that there is a huge array of countries sending more crude to the European market. And basically, you also see that the volumes here are higher than the declines from Russia and a couple of other countries. So Europe has increased its crude imports throughout the country, throughout the year, most of the time, especially over the summer months. Imports have been very high. And we have also seen crude stocks in Europe building to, I think it's actually even an 18-month high or something like this. So Europe has been relatively well off in replacing these supplies. It was relatively easy. One final point I would like to make, we see here that a couple of Middle Eastern countries are strong in this contribution to the additional European supplies. So it is type of the most important source. And that leads us a little bit also to the question of what OPEC will do next. And Serena will tell us about this.
Cheers, David. So OPEC Plus recently made an announcement that it will cut 2 million barrels per day of its production from its baseline current targets. But what's important to note is that the actual impact and the shortfall in supply is likely to be closer to about 0.8 to 1.1 million barrels per day. And currently, OPEC Plus exports, most of its crude to Asia as well as Europe. So the question is, which country would it prioritize the supplies to? Now, in our view, we think that OPEC Plus will continue to prioritize Asia over Europe as its key supply destination for the reason that its sale of crude towards Asia typically fetches a higher official selling price, or what we call OSP, compared to Europe. And at the same time, there is the need for it to fulfill its term contracts. But technically, with lower supplies, OPEC Plus will be able to raise its oil prices. But if it's overdone, what it would do is to drive Asian refiners to look for alternative, more attractive sources from the Atlantic Basin. There is also the other function of looking at the demand side of things in Asia. Well, we're already starting to see, initial indicators showing that the oil demand globally is already going to slow down, and with potentially diesel demand as the last burst this winter. So potentially next year, we could see a slowing down of oil demand globally, but also in Asia, which means that Asian refiners themselves could be importing less crude overall. And for the more price-sensitive Asian refiners, they could be looking to tap into their onshore crude inventories and defer any potential purchases if the oil prices are not attractive. So overall, we think that the impact of OPEC Plus production cuts on Asian refiners will be relatively limited. So let me pass on the time to Rohit to talk about the Russian exports.
So talking about the Russian exports, like we all know since the start of the Russia-Ukraine conflict, right? What has happened is over these past months, buyers in west of Suez, they have actually, especially European buyers, American buyers, they have shied away from these barrels. Like it's sort of, they've stopped taking these barrels. Europe is still taking, but even as we move closer to that December deadline that David talked about earlier, you'll see lesser and lesser Russian barrels heading that way. Now, what has happened? There has been a shift, right? So where are these barrels heading? These barrels are undoubtedly headed to Asia, as you can see on the left-hand side chart, the blue bars. That's the spike that actually started off after, since March, April. So all these barrels, especially Chinese and Indian refiners especially, they hardly bought any Russian barrels before this conflict. But ever since they were offered these discounted barrels from Russia, they sort of lapped up on these opportunities for purchases, and they have been taking these barrels. Well, there is some news or some hints that as and when these sanctions will come into effect, or this ban on Russian barrel comes into effect in December, some of the Indian refiners, especially the state-owned ones, they are shying away from these barrels, or they have put a pause on purchasing, any additional barrels after December. But we still do have we still see significant barrels heading to Asia, heading to India, especially because there is that Rosneft-owned refinery, the Nayara. Then there are some private buyers like Reliance who are still taking in Russian barrels. So we'll still see significant volume heading that way. China is obviously taking Russian barrels. They were also India and China. They were actually competing for ESPO barrels as well. That we can see on the right-hand side chart actually. So what has happened? So the flows, as they have shifted to east of Suez, Russian crude exports from west of Suez origin ports, that they have actually gone down. So you can see there has been a sort of decline in loadings from Baltic and Black Sea. We see increased loadings from Russian Far East. That's because those, China and India competing for those ESPO barrels. But yeah, overall, yes, there has been a fundamental shift in how the Russian crude is being exported and where it is being exported. And yeah, pass it on to Serena for that.
Yeah, so the key question is that as the EU ban on Russian oil imports kicks in and draws near, will Russia be able to court more Asian refiners to buy more of its crude? And if we look at the Russian crude imports by destination region so far, and you look at the left chart with the yellow bars, we've seen that the interest, especially coming from China, the interest for Russian crude imports have been on a downtrend. the imports and appetite from Indian refiners continue to remain robust, but I feel like this is on the condition that the Russian crude are priced attractively relative to the other term as well as spot barrels in the market itself. The question is also which Indian and which Chinese refiners are buying the Russian crude, and particularly looking at Russian euro so far. And looking at the ports that have received the Russian Euros barrels on the right table, we see that many of them have been going into Sika, which is dominated by Reliance, Vadina, which is where Nayara refinery is located, Mundra Port, where there is a shared terminal for imports of crude by HMEL, IOC, as well as HPCL. And the total volumes for India's Russian Euros imports are much higher as compared to China. And if you look at China, each of the ports are actually importing a pretty low and fragmented volumes of Russian Euros. And we see that, in terms of the appetite for Russian Euros, it's not really strong as compared to the Indian refiners, particularly because especially the Chinese state-run refiners, they choose to remain politically neutral, and hence, for them, importing Russian Euros is really not a top priority for them. But what's also interesting is also in the past months, we've seen how, a couple of spot Russian barrels have been arriving and discharging in countries outside of India and China, particularly Sri Lanka. We see the first cargo since November 2020 arriving in the country in May this year, and Malaysia more recently in September. So there is signs and indicators that Russia is trying to attract more and more Asian refiners to increase their appetite for crude. But I'd say that in terms of the prospects, the ability for Russia to sustain its exports after the December ban, that will be very much determined by the availability of logistics, typically or specifically the availability of tankers after the marine insurance ban were to be put in place. And we'll talk more about that in a later stage. But before that, let me hand over the time to Emma to talk about Russia in the context of China.
Okay, now let's zoom in to China's seaborne Russian crude imports. On the far east side, the May grade Expo blend has been Chinese all-time favorite, along with pipeline oil. We can see from the bar chart on the left that China has been receiving more of Expo exports since May, with only a few cargoes diverted to other destinations such as India. The smaller independent refiners in China, or so-called teapot refiners, have received higher volumes in recent months, while Chinese state-run refiners have maintained relatively stable imports. We believe that Chinese refiners will continue to haul in the Expo barrels going forward. There might be some hassle when EU sanction kicks in, but the shipments should get back to normal very soon. And on the west side, China's Urals crude imports have also picked up, but the supplies to the Shandong teapot have declined since August because the delivered price has picked up and lost competitiveness to other discounted grades such as Iranian light crude. In fact, teapot refiners have been struggling with high feedstock prices since Q2, and they have cut back imports of spot barrels from West Africa, etc., and stick to those discounted grades from Iran, Venezuela, and Russia. Their refining margins were further dampened since August when Beijing started another round of probes into tax evasion and quota reselling. So they may not be able to lift run rates in near terms, and the demand for euros may stay muted if the landed price remain high. Speaking of China's crude import, on next slide, beside the teapot refiners, the state-run refiners are set to pick up crude imports in coming months. We can see from the shipping data, China-bound crude loading in October so far has picked up significantly. The biggest increase are seeing Saudi barrels as Aramco lowered its October OSP official selling prices for Asia, given that Aramco has kept November OSP to Asia unchanged. We expect Saudi-led OPEC Plus will keep supplies to China steady to maintain its market share, despite a recent supply cut announcement. And because the OPEC Plus barrels, excluding Russia, Iran, and Venezuela, are mostly received by state-run refiners, we have seen that the trend have also materialized in freight market. From the right-hand side chart, we see that the VLCC freight rates on all major China-bound routes have picked up strongly into the May trading week of October, as any additional crude demand from the state-run sector will likely be supplied from the conventional suppliers from the Middle East and Atlantic Basin. Now I will hand over to Rohit.
So talking about what the Americas are doing in supplying Asia, right? So on the left-hand side, we just have the US seaborne crude condensate exports to Asia. What has happened is US exports to Asia, they actually took a back seat during the first half of this year, with more and more US exports actually heading to Europe instead of Asia. We saw this trend starting, late, in last quarter of 2021 and continuing on right up to first half of 2022. Now, what has happened, Asian buyers have actually showed renewed interest, especially your buyers in South Korea, buyers in Taiwan. They have actually started taking more and more Asian American crude, US crude, for example. And what that means is Asia has again become the top destination for US crude exports. Now, what we believe is these exports will stay resilient. We also see, in those initial months, May, June, July, US exports going to India going down significantly, but even they have recovered now in September and even first half of October. We see this will continue. Exports to Asia will stay resilient. What is actually a bit, not that promising is export to Asia from rest of the Americas. Now, when we talk about rest of the Americas, that is everything all the way from Canada to Argentina, except the US. What has happened in this, since the Asian buyers moved more towards the Russian barrels, these were the American barrels, especially Latin American barrels. They were the ones who were affected the most. Well, there have been some instances where we had recent news where the Indian buyers were going into long-term contracts with Brazil and Colombia for those barrels, but it hasn't helped that much. So overall, as we see from the latest data, the first of October, the exports from rest of the Americas isn't as strong as the ones from US crude going to Asia. So that's something, and then talking about the whole Atlantic basin, on the whole complete Atlantic basin imports into Asia. Now, when we talk about Atlantic basin, we mean your West African barrels as well as Russian exports from the Baltics. So, like Serena mentioned earlier, so India has been buying those Urals, and we can see that in these purple bars over here in this chart. The imports from Atlantic basin, they have been more or less stable, but we do see increase from Angola. Angola actually increased their exports last month as well. So we see these in the chart. Nigeria has been struggling with their production, so that is one case. But yeah, the bright spot, I would say, is United States over here. But will this be a continued? Will this have any upside? We'll discuss that in our further slide going ahead when we talk about the production. But yeah, for now it seems Atlantic basin barrels are heading to Asia, but still in a very sustained manner. And yeah, to talk about how they are heading there and the VLCC utilization behind this, I pass it on to Billy.
Thanks, Rohit. Yes, if we just focus on the right-hand chart for a second, we'll zoom into the VLCC involvement here. What you can see is the increased utilization by VLCCs heading towards Asia. And this is largely on the TD22 route from the US Gulf to China. Now, this is one of the driving forces that we've seen behind the increasing VLCC rates. And this is one of the reasons that the tanker rates are going higher, is that the mileage is then increasing because these are much longer voyages. And as you can see on the left-hand chart with the relative average loadings and volumes, we can see that the increased earnings are likely more due to increased mileage rather than increased volume. And then if we move to the next slide, what we can see is further evidence of this. On the left-hand side, what we have is volumes and ton miles compared to the pre-pandemic levels. In the red line, we see the volumes. We can see a slight uptick so far this quarter. And that's also representative again of there is an increase in volumes, but it's not as significant as you would hope. And what you can see on the ton mile side is that most vessel classes have been below pre-pandemic levels in terms of tanker demand, with the exception of Aframax tankers for the last 2 quarters. And what you can see is for VLCCs in the blue bars that they have been improving, but not yet able to breach those pre-pandemic levels. And the increases as well, especially this quarter, is because of this increase we've seen in Atlantic Basin to Asia flows, increasing the mileage. And that's in turn is helping to support dirty tanker rates, which you can see here on the right-hand side, where you can see the strength for the last few months. Now, this an important thing to note here is that this is largely representative of this end of year peak that we expect to see usually, and the consensus is that this is largely has passed us by now. And looking ahead with the OPEC production cuts as well as recessionary fears, it's not looking like demand going forward is going to support this further. So what we can see here is potentially a correction in dirty tanker rates going forward. I'll pass on the time to Ruslan.
Thank you. So as many of you know, Russia is the world's largest fuel oil exporter, accounting for about 20% of global exports. And what we're looking at here basically is the great migration from basically Russia exporting fuel oil to the West, and now it's going increasingly going to the East. And this is obviously because of sanctions in the US and looming sanctions in Europe. So if we focus our attention to west of Suez imports of Russian fuel oil, in the left-hand side chart, we'll see that basically, so for example, Europe was a huge customer for Russian fuel oil. And in August, it hit like a record low. And ever since then, it has been creeping up slightly. And this is probably, you know, to accommodate bunkering demand, the refinery feedstocks. But I mean, again, you know, looking at in the bigger picture, the volumes are way less than they used to be. And as we approach the February deadline for seaborne refined product imports, we can expect these volumes to come crashing down and set new record lows. And so where's all this stuff going? East of Suez. So we're, you know, ever since the start of the war in February, late February, we've been seeing an uptick in Asian demand, Middle Eastern demand, and Africa as well. But I mean, I think, well, it's pretty clear here that Asia takes the pie here. Asia's acting as the new, you know, demand center for Russian fuel oil. As we can see also in the Middle East, during the summer months, stepped up its imports of Russian fuel oil quite significantly. And of course, you know, the Middle East increases fuel oil consumption during the hot summer months because of increased power generation demand. But now that that is behind us and temperatures are starting to cool, we're seeing that Middle Eastern appetite for Russian fuel oil is actually starting to soften. And in the next slide, we're going to take an even a closer look at where those Russian fuel oil exports are going. So on the left-hand side, we have Asia. So it will probably not come as a surprise to many of you that Singapore is importing quite a big chunk of this, because Singapore being the bunkering and trading, fuel oil bunkering and trading hub that it is. A lot of the supplies are coming here. India has been importing a little bit more, quite a bit more over recent months. China is quite interesting in the sense that, once the war began, a lot of people had expected that, China would be one of the first ones to jump into the market and, snap up all these discounted cargoes, so, not only for fuel oil, but also for crude. But what turned out to be the case was that, lockdowns and limited demand saw China only come into the picture a bit later. But in recent months, we have been seeing increased appetite for Russian fuel oil from China. In the right-hand side chart, as we mentioned, Middle East demand was strong during summer months, and it's starting to come off now. What I find particularly interesting here is Egypt. As you can see, Egypt volumes have kind of come up out of nowhere, and the reason for that is that Egypt is actually serving as sort of a waypoint for Russian fuel oil cargoes. So they're usually sort of exported from the not Baltics, but the Black Sea, and then kind of SDS in the Kalamata region, or go straight to Egypt. And from there, they're shipped through the Suez, transshipped through the Suez onto other destinations, mainly Middle East and Asia. And so what that means for in the next slide, please, what that means for the Singapore hub. So for example, all the floaters, the long-term floaters that are anchored off of Singapore that store a variety of fuels, what we've been seeing is the high sulfur fuel stocks, floating stocks, have actually ballooned since not too long after the start of the war. So not this week, but earlier this month, high sulfur fuel oil stocks hit a record high. And these are for records that go back to the start of 2020, when Vortexa started tracking these inventories. And this is likely to be a trend that will continue as Russian supplies increasingly head east. And with that, I would like to pass on to David, who will talk about light end.
Yeah, before we do that, Ross, may I ask you a question on your slides
Sure.
related to a question from the audience? What do you think, what happens to the Russian barrels that goes to places like Singapore, Malaysia, UAE? Where do they ultimately end up, apart from the floating storage to a certain extent in there, evidently?
Specifically for the fuel oil ones, so in the respective bunkering markets, for example, is one big outlet. So again, Singapore is the world's largest bunkering hub, accounting for 20% of global sales. Fujairah is number 2 or number 3 in the world, depends on what month you look at. So a lot of those volumes end up in the bunkering pool, but then also some of those volumes end up in the refining system. So, but it's hard to say definitively the refining feedstock ones where they end up, because once they go into a tank, they're blended. So it is really hard to say. But there's the obvious places that have high demand for refining feedstocks, secondary unit refinery feedstocks, which are places like India, South Korea, places like that. And then also in the power generation sector. So South Asia is a big candidate for this. Places like Sri Lanka, Bangladesh, Pakistan. But again, with the peak power demand season coming up, we're starting to see lower appetite from those power generation consumers.
Yeah. So perhaps a follow-up here quickly also with some other comments and questions. I think we don't see any significant volumes of fuel oil going back to the European markets, which are actually Russian molecules. That's a type of speculation out there, but I don't think it's happening too frequently. And as for storage capacity in Singapore, what you can see on this slide, the red line is the capacity, which is basically VLCCs, as far as I know, exclusively. Yeah, you know, you can just add additional VLCCs as has already happened over the course of this spring and again over the last couple of weeks. So if there is more need to store fuel oil, and potentially also some crude components in that market, then usually the traders will just add a number of old vessels to that market. Okay, so let's now move on to the clean market and to the demand side. We start here with light distillates. On the left-hand chart, you can see gasoline and naphtha imports by the two basins. Yellow line, Pacific Basin. You can see the September import value has been in line with the red line here, really one of the low-end range, except for the deepest Corona lockdown period. And if we look at the Atlantic Basin now, with the first days of October, first half of October, we are actually also at the extremely low level, just below, with few months in the peak Corona lockdown period below that level. So evidently there is not that much demand. On the naphtha side, that's not really anything new. We see this on the right-hand side, blue bars. Northeast Asian naphtha imports have been low essentially since nearly the beginning of the year, and partly trending even lower. On the gasoline side, it's a more interesting question, but ultimately we may simply be in the period where where inflation is increasingly having an impact on disposable income. Some of the governments are not anymore able to subsidize gasoline at the same level they did earlier in the year. The overall cost pressure is probably hitting more and more people around the world and making them reduce their consumption. So evidently, I think in my opinion, it's pretty clear that we are I think we're already in a recession, but we're definitely heading into one, and that's feeding through. One quick comment on the Indian LPG imports. So you can see LPG imports are actually trending up, and that's the case for India, but also for many other places, because LPG is a viable, cheaper alternative to some other oil fuels like diesel, but of course also to LNG. So the strong competition that is driven by the European market trying to get in as much LNG as possible is also leading to a situation where wherever it is possible, players try to switch to LPG, and that is increasing the LPG imports into the Asian markets in general, but also into the European market. But not everything is bleak, isn't it, Serena?
Yeah, definitely, David. So if you look at the demand, the global demand for diesel, well, we know that the diesel demand in Europe is really strong because of winter heating. But if we look at two other potential destination markets, one on the southern hemisphere, here we're looking at LATAM diesel imports, and on the right chart, we're looking at Southeast Asia. Both these regions have shown that diesel imports are actually growing or have remained relatively robust. So if we look at LATAM, what's happening is, especially in Brazil, the very strong agricultural yield has really jacked up the diesel demand there. And in Chile in particular, because of the drought, there has been an increase in diesel imports for power generation. So because of these two factors, it has driven up LATAM diesel imports by quite a fair bit, especially in October. And looking at who are the suppliers, well, obviously, U.S. Gulf Coast is the main exporters, but now in the recent months, we've continued to see diesel exported from UAE as well as India. Now, what's happening in Southeast Asia and Australia? If you look at both the gasoline as well as the diesel imports into Southeast Asia, and here we exclude Singapore and Malaysia because they are typically the storage hubs. So as a measure of the implicit demand of gasoline as well as diesel in Southeast Asia, it has remained pretty strong. And one of the key reasons is because of the government subsidies, especially in countries like Indonesia, Thailand, Philippines, and Vietnam. The government has continued to subsidize the retail fuels to keep the cost manageable and acceptable by the people. And therefore, demand has remained robust, even though the import prices have increased. The question is, how long can this be sustained? And once prices increase, that would have a dampening effect, definitely, for the Southeast Asian countries. And in Australia, we've seen a similar trend, especially diesel imports into Australia is really strong. No surprises here that this is a broad-based economy that depends heavily on diesel for agriculture, for mining, for road transportation as well. And given the lack of refining capacities and the closures in the recent years, Australia will continue to import diesel in the long term. Back to you, David.
Yeah, so what we see here is basically the supply side reaction to this demand, at least on the left-hand chart. You can see here world diesel exports, and yeah, evidently I would say this is a pretty impressive chart. You barely see such huge deviations from an historical range in the oil market. So evidently there is a lot of effort around the world to supply more diesel to the markets. Where does this come from? Basically the two type of sources. The one is just running refineries higher. That is definitely happened to a certain extent. But the other one, and that is also very important, is to shift yields away from specifically light distillates towards diesel, to a certain extent also from jet towards diesel. And that is definitely happening, and it's making a big contribution here. So this is something to keep in mind, because the more the refining system is able to push out diesel, the less likely the diesel rally is going on forever. Of course, we are right now again in a very strong pricing environment. The latest upside there has probably been driven a lot by the outages of the majority of the French refining system. That, of course, was a big blow to the market. And then we are simply now in this period where a lot of preparation is going on. We also think that there is a lot of storage. Yeah, even though you can read in the news that US Northeast stocks or Rotterdam stocks are low, but what we don't have is data on the storage at power generation plants, agricultural businesses, commercial businesses all around the world, so the tertiary stock level. And this massive imports into so many markets we have observed over the recent months, we simply feel it's not all consumption right now, it's a lot of forward building, stock building. Now coming a little bit to the European situation, on the right-hand chart, you can see that Russian diesel flows to Europe are now clearly trending down in the dark blue bars, but there is a massive flow of replacement barrels coming in, especially from the Middle East, also a little bit from Asia and North America. So at least at this point of time, we're at a very healthy track for basically supplying the European market into the winter months. And overall, I personally think that we will definitely see some weaker phases of diesel cracks also over the next couple of months. But then again, the market is of course very nervous, and any bullish news can quickly drive values up again. But fundamentally, there are a lot of things in place that would work towards a rebalancing of the market. Back to you, Serena.
Yeah, and just diving deeper, like what David mentioned, Asia will continue to remain as the marginal supply of middle distillates, both jet as well as diesel, to Europe. And here we see that India has been the key contributor, but increasingly we are also seeing barrels from South Korea and China being very much driven by the favorable economic arbitrage. And with diesel stocks in Europe remaining low, we expect to see that this trend will continue at least through the winter. But we don't know. We don't really know what happens after winter, especially when diesel demand starts to cool. And from an exports perspective, if you look at Northeast Asia, what's really interesting is on the right-hand chart, you see clean product exports by product category, so across both finished gasoline, jet fuel, as well as diesel. And ULSD, which is the ultra low sulfur diesel, has been creeping up in terms of its yields relative to the other clean product exports, making up close to 33% in October. So this really shows the strength and the market share that ULSD is taking in terms of exports from Northeast Asia. And so, like what I said earlier, right, this this diesel exports could be just a short burst, given very much strong, driven by the strong yields and the strong cracks. And we do not know what will happen potentially after winter this year. So like what David mentioned, we could potentially see a cool down in cracks and in turn, a decline in the refinery runs and exports. Emma, what's happening on the China front, looking at product exports?
Yeah, so we know that last month, China has issued a new batch of product export quotas amounted around 13 to 14 million tons on top of the 24 million tons that have already been granted for the year in previous batches, just to encourage the refiners to pick up runs and pick up exports. It says that this additional quota can be used till end of March next year. So given that the refiners still have 7 to 8 million tons of unused 2022 quota at the end of September, if the refiners aim to utilize all the quotas, they need to increase export to 5 to 6 million tons per month in the last 3 months of the year. However, our flow data indicates that China will only export around 3 million tons of fuel, mainly on diesel and gasoline, in October. Although this is already a 30-month high, but it's still below the allowed amount. So the question is whether China will boost export in November and December. The answer is they may not be able to boost export in near term. So we know that China's overall crude imports haven't recovered much in the months, and our crude onshore storage data shows that China's stock draw has halted in the months. They all suggest that the refiners are not really increasing run rates in the months. And as Beijing requires the oil majors to secure domestic fuel supplies over winter, we don't think China will increase export in November. But as I mentioned in earlier slides, China has lifted crude imports, crude loadings in October. So if the barrels get in November and December, China may pick up run rates and start to increase export in December onward. I will hand over to.
Thanks, Emma. Thanks, Emma. Yeah, I will just give a quick overview of the clean tanker market, given what we've heard so far. So what we see on the left-hand side is a similar chart to the dirty slide we had earlier, with volumes in the red line compared to pre-pandemic levels, as well as ton miles in the bars compared to pre-pandemic levels. We can see this marginal increase in volumes so far this quarter, but still remaining about 500,000 barrels per day below pre-pandemic levels. And this increase is probably largely driven by the increased diesel movements we've seen more than anything else. And what we can see on the ton mile side is not much of an improvement from most tanker classes. You can see LR2s have breached the pre-pandemic levels again, but MRs have actually given back some of the increases that they've seen in previous quarters. And that's reflected as well in the baskets that you see on the right-hand side, where we see MRs in the Atlantic Basin as well as in the Pacific, all under pressure. As well as overall, another thing contributing to the decline that you see here in clean freight rates is also the weak naphtha market. Now, just to go back to the left-hand side, you can see LR2s have seemingly escaped this weak naphtha trade route, and that's as a result of them moving into the stronger middle distillate market. But it's not the same for LR1s, which you can see in the light blue, they have lost employment in the naphtha routes and have not been able to transition quite so smoothly. And then looking ahead with the demand concerns as well as potential refinery adjustments, and the fact that we have some doubts as to whether China will be able to increase some of the exports out of there, it's not likely that we'll see much support for these clean rates, at least for until the end of the year. Yeah, I'll hand over to you, David.
Yeah, perhaps let me just also very quickly sum up, so to say, this freight observations. So we have seen this very strong freight rates on the dirty side and the weakening on the clean side. And the question is a little bit, what signals are we getting from that? I think it's fair to say that the upside on the dirty side has a lot to do with expectations, forward-looking, increased Chinese imports, which, as shown, is not so important that it will not so sure that it will actually materialize. It has, of course, to do also with this big uncertainty about the fleet in line with the Russian reshuffling. On the clean side, basically the factors that are driving rates lower appear to be, so to say, a type of more real and actual, yeah, like the lack of demand on the light distillate side in particular. The adjustments on the refining side, which ultimately will need less trade flows around the world. So we would tend to say that the clean rate indication may be the more important for the market than the strength we see on the dirty side. Now, a lot of that is related evidently to the Russia question. We are now getting more and more into the hot phase. Europe is replacing its imports of Russian oil already to quite some extent. So this is done for fuel oil and for crude and also for naphtha. For diesel, there is still a big chunk to happen. So Russia can still send the majority of its diesel to the European market. But the question is simply what happens when they cannot anymore. And we are of the opinion that Russia will run into significant troubles with the European insurance and services ban on third-party shipments of oil that comes into force in line with the crude and product import ban, so for products 5th of February. And while there is a lot of preparations for that, evidently ships being sold, dark fleets being built up, new insurance programs being developed, I think it's important just to keep in mind that the amount of volumes we are talking here is just huge. And while people may be able to find some workarounds for some barrels, they are unlikely to do this for all barrels. So, for example, if we look on the left-hand chart, we have these pretty strong imports for India and for Turkey. The question here, for example, is whether these imports can actually be maintained at the same level. Yeah, that in itself may be a big enough challenge, especially for Turkey, which gets most of its imports from the Baltic route. So it's actually long-haul shipping all around Europe. There is also the tightness in the ice class tanker market there that comes into case. So we think Russia will struggle on the crude side, may struggle even more on the product side. Just to give you one illustration, Russia is basically sending very little diesel to the entire Southern Atlantic Basin market. So everything of Latin America and West Coast Africa, the total in September has been less than 20,000 barrels per day. That would be a natural replacement market for them, but they cannot access it. Yeah, it's just too difficult to set up trades. And that is even at this point of time where it's perfectly legal to do so. The insurance ban is only coming into force later. So we will think that this will really cause volatility. It will cause a loss of supply, which of course then will boost prices again and will eat on the demand side even more. We don't think it will be a permanent solution. Probably some workaround will be found either via alternative insurance or via the price cap actually coming into force. On the price cap, I'm much less optimistic now than I have been perhaps a couple of months ago. Simply, there is not much progress. But the point is that Russia will anyway have to offer discounts, yeah, whether they're then as deep as necessary for meeting the price cap criteria, we will see. Yeah, they will struggle and we will lose supply in the market. And that is, of course, a big concern of the US and many other players. Yeah, running out of time, let me move on. Thanks for the hint. What we see here is just quickly where Middle Eastern oil exports all across the board. Left-hand chart, you can see where we stand seasonally. Right-hand chart, we have only products, and you see what massive addition the Middle East provided to the global product market over the last half of year. The point I would like to raise here is how much more can this specific supplier add to the market? But are we not also generally running into the peaks? We have seen this massive Latin American diesel imports. At some point of time, this development will stop, it will peak. It's just not particularly feasible in this current market to assume that Latin American diesel imports will grow and grow and grow forever. So I think we overall have a lot of peak type of elements in the market. Of course, there are some refining capacities on the sideline and plan to be started up relatively soon, so that can add a bit of supply. But on the crude side, and that leads us to the final slide of our presentation, on the crude side, we simply face very severe limitations. We have here on this left-hand chart a type of grouping of supplies of exports basically into different type of risk and supply upside potential groups. And essentially, you know, there is a lot of groups that are either under strong risk like Russia, Kazakhstan, Iraq, or under some risk, like all the OPEC countries and a lot of other markets, but there are barely any places that really have upside in the green bars down there. And out of those, we have put into this green bar originally Iran, Venezuela. I think the outlook is now much less optimistic than it was a couple of months ago, that these countries can actually add to the supply picture again. And even the US is not anymore seen as optimistic, and perhaps Rohit, you can provide us a couple of comments here on what's going on there.
Yeah, so in terms of US, right? So until a few months ago, I would like to say, as we were exiting second quarter 2022, pretty optimistic on US production, you know, great upside as well. We were expecting to exit December 2023 at 13.4 million barrels per day, but come final quarter 2022, the whole scenario is completely different. So US producers are still prioritizing their shareholder returns, and producers, like you have your private equity backed guys, your mom and pop shops in the Permian, the ones who actually want to go ahead and drill and increase their production, they are facing labor and material shortages. So a lot of issues with US production as well. Now, we had a question earlier in the chat room, like, will Europe be able to get more crude from US, Guyana, and Brazil? My answer, the short answer here is, I mean, the Americas, they would be able to sustain the current level of exports that are going to Europe, but any additional barrels, I don't think so, at least not until, you know, later second half of 2023, because you have these issues with US. On the right hand side chart, you can actually see how even the EIA has reduced its latest, you know, short-term energy outlook forecast. I mean, they have gone from 13.4, like I said, in June, to just 12.6 exiting December 2023. So that just tells that we will not see any significant growth in the US production. Now, there is the question of Guyana. Guyana is already exporting as much as they can. Maybe they can shift some volumes that are going to North America, especially the US. They can shift those volumes to Europe. And Canada is a place where we are seeing increased production. Not too much, but whatever is being increased, I mean, whatever increased production that we see from Canada is again constrained, you know, in terms of their geography. So they still have to rely on their pipeline system, taking that through to US Gulf Coast and out to export. So yeah, Europe will have some rough seas ahead when it comes to importing from other sources.
Thanks, Rohit. So just to summarize the key takeaways from our entire webinar, what we're seeing from a supply perspective is significant downside risks to global supply next year, stemming from the fact of OPEC plus crude production, the Russian sanctions, and geopolitical risk and instability in oil production globally. But part of this risk is kind of counterbalanced and offset by the slowdown in global economy. Already we're seeing naphtha and gasoline demand really struggling globally. And for diesel itself, it's a question of whether this is like the last burst of demand that you will be experiencing. And thereafter, next year, we do not know what could potentially happen. On the Russian side of things, well, it seems right now so far that the Russian has managed to grow their market share of all exports to the Middle East as well as Asia. Now, the key challenge that they will face and they'll be put to test is how much logistics in terms of the tanker availability that they will be able to arrange to continue to sustain the exports. And if they were to be interested to expand their exports to more destination countries. And in the past few months, we've really seen a reshuffling of oil trade flows that's really driving up terminal utilizations to a certain extent, especially on Aframax tanker side. But in reality, we see that there are more downside risks to these tanker rates, as what Dylan has discussed earlier on. So with that, we come to the end of the webinar, and now we would like to open up the floor to a few questions. David, do we have any questions in the chat room?
Yes, we got quite a lot of questions. We tried to answer some of them also throughout the presentation, but let me reach out to Emma. Emma, there was a question about the new refineries, whether we already see crude flows, and perhaps you can also tell us how we track the crude flows to China via Singapore and Malaysia in a short note.
Okay, so first on the flows to the two new refineries, as we track flows into terminal level, we can see the two refineries are actually receiving some cargoes in recent months for their own plants. But looking at the volume they have received, I don't think the two will start full operation very soon. They may just start at trial runs in near term. And for the STS, although sometimes the STS will conduct in dark, but the vessels, we can follow up the vessels going to the end buyers, usually in China. So from our flow page, you should see them reaching Chinese ports.
Thank you. A quick question for Rohit. There was one on how much crude India can absorb.
Yeah. Actually, it was a thing how much more Urals can India ingest, right?
Yes.
So technically the answer is yes, much more, but will they do that? I mean, we saw when they started taking in those significant quantities of Russian Urals, right? In May, June, we saw their term suppliers in the Middle East, especially Iraq, fighting back with further discounts on the spot barrels. So that is something these suppliers, Saudi Arabia and Iraq, they will protect their turf. They consider that as a sort of a captive market for their barrels, and they will protect that against anything. Not only that, the official policy from the Indian government is more of diversification in their crude supplies. So the short answer is, even though they can take in more Urals, most likely they'll not take more Russian barrels, just not to antagonize the Western countries, as well as keep their long-term suppliers in the Middle East happy.
Yeah, many thanks. Sorry, I'm trying to read all the other questions. Let me try to answer a couple of them myself quickly. The value of Urals is very difficult to assess going forward already now. The Brent Ural spread, of course, it will widen, but the question is how valuable the assessments are. So the price agencies will have a hard time to get the actual quotes on Urals, but Russia will have to offer very cheap prices to keep its oil flowing. China inventory, of course, Emma would be better position to answer that, but I can just tell you doing a lot of work that we capture as much as possible. In the case of China, it will never be everything, and there are new tanks coming in, and of course we're trying to get them as quickly as possible into our platform. There is no 100% coverage for that market, but we're pretty confident that we're doing the best job, at least on a relative basis. SPR, I think, is a very important question because we shouldn't underestimate how much the US has contributed to the relative well-supplied crude market we have seen over the last couple of months. The problem, however, is, of course, they're adding now more barrels to the market, and that helps again the crude prices, no question. But the more we go forward, it reduces their leeway in the future. And at the same time, of course, if the answer from OPEC is to cut back supplies, then the initial effort is not really being met. So that is to sum things up, I think we have simply a situation where a lot of things point to a weaker crude market over the last couple of months. on the one hand, then forward looking, there are a couple of quite bullish indications, but they are basically in the terms of tightness. Yeah, so I think we will simply come back into a market environment where the demand cannot be met by the available supply on the crude side, where we have then rising prices, and that will feed into the already existing decline on the demand side. And ultimately, of course, this will then bring the level of the overall oil industry you want, and also the shipping industry to a lower level. Yeah, I think, yeah, I see one question on the diesel inventory treasury side. I think this, yeah, I cannot answer it. I think it's impossible to say. But overall, of course, the stocks that are held at the final consumer, you know, it's a lot of small tanks, so it's overall very significant volume. So if we remember this chart with the massive spike on a seasonal basis in global diesel flows, of course, this points to quite a lot of stock building, because it's very unlikely that the actual consumption at this point of time is going up like this.
All right, I think we are on the dot. And thank you all once again for joining us. We look forward to seeing you at the next webinar. We have a second session in the MES and Americas time zone, so look forward to seeing you there. Thank you and have a great rest of your day. Bye-bye.
Thank you.